Physical Gold Fund presents The Gold Chronicles with Jim Rickards and Alex Stanzik. Insights and analysis about economics, geopolitics, global finance, and gold.
Hello, my name is Alex Stanzik, and welcome to episode 91 of The Gold Chronicles. Today is February 5th, 2020. I have with me today my esteemed friend and colleague, Mr. Jim Rickards. Welcome, Jim.
Thank you, Alex. It's great to be with you.
It's great to have you back. It's been a little while since we did our last podcast. I know a lot of our listeners have been eagerly awaiting and looking forward to another podcast. Before we dive into today's podcast, you can access an archive of the podcasts and transcripts that we have done going back several years at physicalgoldfund.com/podcasts. If you watch this podcast on YouTube and you're interested in this podcast and you want to see us do more of these, the feedback that we get is real important. So if you like it, please take a moment to subscribe, like, as well as feel welcome to comment below. Let us know what your feedback is. And we love to hear from you guys. So Jim, why don't we dive right in?
Sure.
Starting with kind of a recap, a very brief recap of 2019, what would you say was the single most influential event of 2019, and what do you think the impact of that is going to be, the effect of it into 2020 and beyond?
Well, I'll give you a definitive answer to that question, Alex, but before I do, I just want to drop two footnotes. Number one, it's quite often the case, and this is what history teaches us, that when you look back from a greater distance, what is likely to be deemed the single most important event was not necessarily a big deal at the time. Things have a way of spiraling out of control. We all remember the financial crisis of 1998, but not so many remember that it actually began in June of 97. We all remember the financial crisis of 2008, but not as many remember that it began in the spring of 2007. So the point is, it sometimes it takes a year or longer for some event to really gain its complete magnitude. So, and that said, these things are often off the radar screen. The other point I would make is that in picking out an event, I would make the point that it's rarely something that was necessarily foreseen. In other words, the event pops up, but it's not as if a month earlier or 2 months earlier people were standing around saying, "Oh, I can't wait for this to happen." It's usually something that was not in the playbook. So for 2019, my view is it was the spike in repo rates in September and the Fed's response ever since. When I say repo, let's clarify for the listeners. A repo is short, or it's kind of Wall Street lingo for a repurchase agreement. It's a financing tool where I've got some good collateral, probably Treasury securities, but I need some cash. So I borrow the cash from you and I send you the securities as collateral, but there's an agreement that I'll buy them back at some point. But the some point is an open issue. It could be overnight, or it could be a week, or it could be a month, or it could be overnight, but we roll it over for 60 nights. So it's really a 2-month loan. So that's what a repurchase agreement is. That's what a repo is. And there's an interest rate associated with that. And it's very close to any other short-term rate, Fed funds, LIBOR, or any similar rate. There are slight differences based on credit, but that's how the government securities market is financed, by dealers buying securities, pledging them, getting cash, buying more securities, pledging those, getting cash, and building up a pyramid of these repurchase agreements. What happened in September was that there was a spike in repo rates. They went way up almost overnight, well beyond comparable rates for short-term loans and overnight lending. And then, of course, the question is why? Well, there was clearly a shortage of collateral. Dealers were scrambling to get the collateral, and we're willing to pay almost anything there was a shortage of cash, and dealers were scrambling to get cash and pledging collateral to get cash, but there was a shortage of willing lenders. So clearly there was a cash shortage, if you will, and it really came from the fact that. So then I'd say, well, why was that? Well, the banks had the collateral. People like J.P. Morgan and others, they had the government securities but they were basically unwilling to enter into overnight cash transactions or short-term cash transactions with counterparties, whether it be hedge funds, institutions, smaller banks, etc. And so there was this mad scramble to get cash, bidding up repo rates. And then the Fed, they're always a little bit slow off the mark, but they noticed it and they said, okay, we have to come into the market and alleviate this cash shortage a little bit. So they began buying treasury securities, in effect, flooding the market with cash to alleviate the cash shortage. But they deal directly with the big banks. So what they were doing, they were giving the big banks cash, taking in mostly short-term treasury bills, 30-day bills, 60-day bills, et cetera, as their collateral, flooding the market with cash. But they did so in the hope and in the expectation that the banks would then do the same thing with smaller customers. When I say smaller, these could be billion-dollar or multi-billion-dollar hedge funds, but they were the bank's customers. So in other words, the banks were conduits or intermediaries between the Fed and the marketplace to alleviate this cash shortage. The whole time, you have to be asking yourself, well, what's up with the cash shortage? The Fed has printed trillions of dollars over the last 10 years. Why is there a cash shortage? And the answer is there's been, lending and leverage. Yes, the Fed has printed a lot of money, but the lending and leverage exceeds by multiples the money printed, and so there can be a shortage in that area, and there was. And so the banks, at least initially, did not do what the Fed wanted them to do. They said, "Thank you very much for the cash. We'll just give it back to the Fed. We'll deposit it with the Fed as excess reserves, and not lend it to the marketplace." So initially, it wasn't the purpose of that exercise was not being fulfilled because the cash was not getting out into the marketplace. And then behind all this, behind the curtain, you have to ask yourself, well, was there somebody in distress? Was there a dealer who was failing? There was a hedge fund that was failing. That didn't materialize, but we do have to ask ourselves if that's what was going on, and we were maybe on the brink of something much worse. Well, anyway, the Fed just kept it up. They kept increasing the amount of overnight lending, et cetera. Now, the Fed at the time, we're talking about late September into early October, they said, well, we're just going to do, 70 billion or so a day, and we're going to roll it over every day. So you can't add it up. It was just an amount that was rolled over. But then that was increased to 100 billion. Then it was increased to 200 billion. And then the overnight became a week, and the week became 2 weeks. Well, here we are 5 months later, into February 2020. And guess what? The program is bigger than ever. The terms of the repo have been extended. There's been no reduction in it. They haven't been able to end it or reduce it. Now, I call this QE4. A lot of people disagree with that. The Fed disagrees with that. But we're arguing about definitions. The technical definition, bear in mind the Fed denied that they were doing QE to begin with. They had another name for it, but QE sort of caught on and stuck, and we got to QE2 and QE3, et cetera. And the QE, as it was exercised by Bernanke and Yellen, Janet Yellen, was basically long-term assets, 10-year notes predominantly, and what's going on now is with very short-term assets, 30-day bills, 60-day bills, short-term treasury bills, et cetera. So the Fed says, well, it's not QE because we're not buying 10-year notes, we're buying 30-day bills. Well, fine, if that's your definition, then I guess it's not QE, but you're still printing money, you're still expanding the money supply, you're still growing the balance sheet. So that's what I call QE. I don't want to get into a long, drawn-out debate about definitions, but the fact is the Fed has embarked in a new, at this point, 5-month, but with no end in sight, program of flooding the market with liquidity to the tune of hundreds of billions of dollars. It's now up to about $400 billion after having started out at the $70 billion level. Now, could the Fed unwind it pretty quickly? Yeah. They just have to let these, repos run off, not roll them over. But they're not, and they can't. And that's really the significance of it. So two things that make this, to me, the most important event in 2019. Well, three things in particular. Number one, it came as a surprise. The Fed thought everything was under control, and boom, all of a sudden, here's this spike in repo rates, and somebody, the system is cash short. Number two, Was there a near failure behind it, some distress that we haven't heard about yet, but it was there and it was giving rise. It's what explains why the banks wouldn't lend the money until the Fed, in effect, flooded the zone and forced them to. And number three, the Fed cannot reverse it. They say they can. Technically, they can, but they haven't done so. This has a much larger significance. This is further evidence, along with the sequence from late 2018 to early 2019. Remember where we were in December 2018. If everyone's, hey, stock market's at an all-time high, well, that's fine. But from October 1st to December 24, 2018, the stock market fell 18%, almost a full 20% bear market. And then Jay Powell got religion and said, okay, we're gonna stop raising rates, which they did. We're going to pause. And then by the spring of 2019, they said, well, not only are we going to stop raising rates, we're going to cut rates, which they did 3 times. And then not long after that, by July, they said, in addition to that, we're going to stop our QT program, quantitative tightening, which is reducing the balance sheet. They had actually reduced the balance sheet from, about 4.5 trillion down to about 3.7 trillion. That's a significant reduction, but now they've reversed course. So where are we now? We had 3 rate cuts, no rate hikes on the horizon. The Fed's pausing, and they're increasing the balance sheet. I call it QE. The Fed doesn't. Doesn't matter. The numbers speak for themselves. So that represents a complete failure of the Fed's effort to normalize interest rates and normalize the balance sheet. They have painted themselves in a corner. They cannot get out. They tried. They got paint all over their feet. They ran back to their corner. And now they're just going to keep painting. So the point is, we're in a system where the Fed cannot get the balance sheet back to normal. They cannot get interest rates up to the level they want. They have to keep cutting. It's like, drugs to the stock market. The stock market loves it, but they can't get off the drugs. And some people say, well, so what? That's the Fed's job, print money. Well, it's fine. But what are you going to do in the next recession? And I'm not forecasting recession, by the way. There's almost no chance of a recession for the remainder of this year. We'll see what happens in 2021. But I'm not forecasting a recession, but there's a 100% chance one will happen sooner than later. And when it does, how is the Fed going to cut rates enough and or print enough money to get out of the recession? The short answer is A, they cannot. They don't have that much headroom. And beyond that, they have now proven that, as I said many years ago, that they are incapable, unable to get to the levels they need to have a cushion for the next recession. So that is a very, very big deal, a story that is still playing out, a story where the full consequences might not be seen for even another year, but it started in 2019.
Yeah. And I was thinking about how, anyone listening to our podcast, I think on a pretty regular basis, I don't think they're as concerned about the actual definition of QE according to the Fed. I think they're concerned about the basically expansion of the money supply is really what it comes down to, because that's what's going to affect gold, I think, more than anything else in the long run. But seems to me like they're trapped. And the next question becomes, if they're trapped and they don't really have tools to deal with the next recession, what happens after that?
Well, that's a very good question. The Fed, in a series of speeches going back some years, Janet Yellen at Jackson Hole I think it was about 4 years ago. The Jackson Hole is this late August conference of central bankers hosted by the Fed, but they invite the head of the ECB and Bank of England and others. So it's a little bit of a central banker confab. Was on that topic, which is, are we out of tools? And of course, the Fed said, no, we're not out of tools. But the problem is, I would invite the listeners and the viewers to ask themselves, have you ever tried hammering a nail with a saw? A saw is a tool, but it doesn't work very well when it comes to hammering nails. The point is, does the Fed have tools? Yeah, I guess so. And I can enumerate them. It's, interest rate cuts, balance sheet expansion, printing money, more QE, forward guidance, currency wars, zero interest rate policy, helicopter money. We don't have to go into long explanations of all of them. I'm sure the listeners have heard them before, but the point is they have a lot of tools in the toolkit, but do any of them work? Is the Fed trying to hammer a nail with a saw, in effect? The answer is yes, they are. These tools don't work, and that's really important to understand. The Fed has two problems. Number one, they don't know what they're doing. I don't say that in a disparaging way. It's just a matter of record. Their forecasting record is abysmal. They have the worst forecasting record of any research arm or analytical arm I've seen. They've made blunder after blunder, and going all the way back to 2013 with Bernanke's taper talk, and that triggered an emerging markets liquidity crisis. They had to back away from that fast. They thought they were going to announce the taper in September 2013. They didn't actually announce it until December 2014. Then remember the famous liftoff. Janet Yellen signaled in March 2015 she was ready to raise rates, and the markets would go, here we go in March, here we go in June, here we go in September. The September liftoff never came. Why? Because the global stock markets were melting down in August of 2015 because China did an unexpected devaluation. They eventually got around to raising rates in 2015. They signaled 4 rate hikes in 2016. We got 1 in December. So almost the full year from December 2015 to December 2016 before the Fed actually raised rates after signaling that they were going to do 3 or 4 rate hikes in 2016. They didn't. Then they got on track in 2017 and kept going. They hand off to Jay Powell. Jay Powell keeps raising rates until December 2018. Everyone says, hey, don't do it. You don't understand. Markets are melting down. The economy is close to recession. Powell raised rates in December 2018. That was a blunder. And then he quickly reversed course. I do give him credit for that. But the point is that they when they do these things that they have to reverse, it tells you 2 things. Number one, it tells you several things. Number one, their forecasting ability is abysmal. They don't see these things coming. 2, they persist too long in the wrong policies, and then they have to reverse course. But they're, the metaphor that it's an arsonist with a fire truck. They light the town on fire and they show up with a fire truck and put out the fire. Like, I don't give the Fed much credit for easing in early 2020 when it was their fault that they over tightened in 2018. So I don't give them credit for easing in 2019 when they over tightened in 2018. And so they're doing it again. But they again, they've really thrown in the towel. They've shown by their behavior, by this new, I call it QE4, call it what you want, that they did over tighten. Number one, they didn't know what they were doing, and they can't get out of it. So this is sort of the history of the Fed. So if you ask the Fed today, they would say, "Oh, no worries, we can cut rates another 7 times." Well, which is true before they get to 0. But then we can do real QE4. I don't know what they're doing now, but if they don't call it that, but they could do more QE4. They can offer forward guidance. We're not raising rates, as far as the eye can see. And don't forget, they can go to negative interest rates. I'm not forecasting that. We're still, 7 rate cuts away. But I have been in meetings with Fed officials, private meetings, where they were very relaxed about that. I was surprised. I just thought that was kind of a taboo subject, but they were like, no, we're studying it and it's on the table, and if we have to do it, we will. Again, we're not there yet, but you have to put that in the mix. So they have this toolkit of QE4, QE5, 0 rates, negative rates, forward guidance, et cetera. The problem is none of it works. None of it works. We're still in the same growth trend. I said this years ago that the U.S. is Japan. It's funny. I've seen a lot of articles recently about the Japanification of the United States. Well, that's fine, but I described this in my second book, The Death of Money, in 2014, and was talking about it even earlier. If you want to understand the U.S. economy, we are Japan. Now, supposedly there was awful economic performance under Obama and spectacular economic performance under President Trump, and that's what you'll hear from Larry Kudlow and Steve Moore and Steve Forbes and Art Laffer and all the other designated cheerleaders. It's not true. Obama had weak performance, and Trump has weak performance. Just look at the growth rate in GDP. It's about 2.2%. On average. Guess what it's been for the last 11 years? 2.2%. Yeah, in their individual quarters, Trump had a good first quarter of 2019. It was 3.1. But Obama had a number of very good quarters. Obama had quarters over 4%. he had 2 quarters in a row over 4%. But the point is, it didn't last. There were always, there's always noise in GDP numbers, whether it's inventory or something funny in the trade deficit. Boeing stopped selling planes. There are always reasons for it, government spending spikes or drops. But when you average it out over 4 quarters and certainly over 11 years, which is where we are now since the end of the last recession, guess what? The growth is 2.2%. And where was it in the last quarter? Well, it was 2.1%, right on target. So I'm not saying Trump has awful performance. He doesn't. But he doesn't have fabulous performance either. He just has the same punk growth that we've had for 11 years. Not much difference really between Obama and Trump as far as that's concerned. Well, that's catastrophic. Why? We're not in a recession. Well, I understand that, but we are in a depression, meaning it's not that growth is negative, but growth is depressed relative to trend. What does it mean when growth is 2.2%, but the increase in the debt on an annual basis is 3, 4, 5, 6%, which it was for a number of years under Obama and is now under Trump? What it means is your debt's going faster than your economy, and so your debt to GDP ratio is going up. You're becoming more unstable, and you're getting closer to the point where you're going to have a debt crisis. So we're growing, yes. We're growing faster than we have in the last 10 years. No. Is Trump better than Obama? He's not worse, but he's not better. Some of the other statistics are a little improved, but you just don't see it in the growth numbers. So and that's reflective of the fact that the Fed tools don't work. Can they kind of keep us out of a recession? Yeah, they have that ability. Can they goose the stock market by cutting rates? Well, stock market, it's like giving candy to a kid. They love it. Stock market loves it. But the idea that any of this is going to solve the debt problem, restore trend growth, or make a big improvement is just not true.
Okay. Speaking of performance under various presidents and whatnot, 2020, as many people are well aware, is a United States presidential election year. Jim, what's your assessment of how this year is going to play out in regards to that? And what do you think the effects are going to be on the market and gold, if any?
Yeah, pretty straightforward. Trump will win the election. That would be my forecast as of now. I give it a greater than 70% probability, but there are factors in the model that have a little theta, which is time decay. They go away over time, and so my expectation is that Trump's probability of winning would go up about 2% a month between now and election day, which means by the time we get to election day, he's going to be kind of a 90% favorite. But I should make it clear, as an analyst, the worst thing you can do is to inject your personal opinions into your kind of cold-blooded analysis. Everyone's got an opinion. Everyone's got a vote. That's the great thing about America. I'm not here to campaign for anybody or tell anybody how to vote, and I respect everyone's choices. I'm an analyst. So this is model based, but I would just, make it clear that in October and early November 2016, I was on a world book tour with regard to my second to last book, The Road to Ruin. So I was doing television interviews all over the world, including New York and London, but also Australia and elsewhere. Great thing about TV interviews is you can save the videotapes. But as an American abroad, and then even on U.S. TV, people say, well, Jim, you're an American. Who's going to win? They want to talk about the presidential race. I was trying to plug my book, but, people naturally wondered about and I said, well, Trump's going to win. I said, it'll be close. We'll be up late, but he'll win. And I then gave very specific answers having to do with skews in the polling, turnout, and other factors. And so it is model based, and I'm using the same model now, updated. You're always tweaking the models and improving them. So like I say, this is not a guess. This is not partisanship. This is just what the model shows. And by the way, I predicted Obama would win in 2012 at a time when all my Wall Street friends and hedge fund friends were running around saying Romney, Romney, Romney. I said, no, the guy's going to lose. By the way, one of the best leading indicators of who's going to win, figure out what the really rich guys and the hedge fund guys are doing, and then do the opposite, and you'll be on the right track. They may be good at making money, but they're pretty bad at politics. Right now, they're all flocking to Bloomberg, so that's a pretty good sign that Bloomberg's not going too far. But So the model isn't multi-factor, but if you ask me, well, what's the biggest single factor in the model? How can we kind of describe this in 10 words or less? And the answer is the probability of Trump winning is the inverse of the probability of a recession before the election. It's as simple as that. So what are the odds of a recession? Well, for the next 3 months, they're close to zero. Between now and November, they're below 20%. You can get different estimates from different sources, but below 20% seems to be a consensus. So what's the inverse of 20%? Well, it's 80%. So if there's only a 20% chance of a recession, there's an 80% chance that Trump wins. I'm fading it a little bit. I'm saying 70 because I'm conservative, and I will add the 2% per month as we march down the timeline, because every month that goes by, the odds of a recession before November go down, simply because there are fewer months within which to have a recession. And so Trump will get to 90 by election day, but take your pick, 70, 80%, but those are the odds. In the 20th century, no incumbent president has ever lost a re-election bid unless there was a recession. Because when you say they never lost a re-election bid, people go, what about Jimmy Carter? What about George H.W. Bush? Yeah, they lost the re-election bids, but there were recessions, a bad one at the end of the Carter term and a pretty bad one at the end of Bush's first term, George H.W. Bush. We're talking about Bush 41. And by the way, that recession was technically over in 1990. And like, wait a second, the elections in 1992, were people still affected by that? The answer is yes. Everyday Americans still thought that we were in a recession in 1992. And the point I make is that it doesn't matter what the National Bureau of Economic Research says. They said it was over in late 1990. That's fine. But if people don't feel it, if you kind of technically get out of the recession, but the job growth isn't there, the unemployment rate's still high, people are still recovering from defaults, real estate prices are depressed, all of which was true through election day in 1992. It doesn't matter. People feel recession and they don't vote for you. So yeah, Carter and H.W. Bush didn't fit the model, but that's because they had recessions. Trump hasn't. There's been no recession in the Trump administration. And so if you don't expect one before November, and I don't, then Trump wins. There are a couple other factors. Impeachment has helped Trump. There's a strong correlation between the intensity of the impeachment effort and Trump's favorability ratings, which are up. His the right track, wrong track poll is up. People think we're on the right track. Lots of polling data, showing that Trump is more popular than ever. So I say to Nancy Pelosi and Chuck Schumer, if you want to reelect Trump, keep it up, because you're only the more you attack him, the more you help him. So Trump wins. By the way, there's another really big factor that's going to help Trump's victory, which is kind of jumping around topics here, but I expect the Fed to cut interest rates in April or June. Now, they're not going to cut them. They didn't cut them in January, of course. They're not going to cut them in March. It's simply too close to the December announcement. You go back to December 2019, when the Fed, in effect paused and said, okay, we messed up at the end of 2018. We got it right. We cut rates 3 times. We ended QT, went back to QE. They didn't call it that. And then, but things seem to be on a steady keel. Well, remember what I said earlier, the Fed has the worst forecasting record around. So if they think it's on a steady keel, it's probably not. There are a lot of headwinds to the U.S. economy right now. The coronavirus is a factor. The Boeing shutdown is a factor. The contraction of world trade is a factor. Europe's practically in recession. It's not technically in recession, but we saw negative GDP prints from France and Germany, and Italy's around zero. They're the big economies over there. So all these things combined are going to slow the economy. The Fed cannot cut rates from July to November just because it's too close to the election. The Fed is sensitive to the accusation that they're trying to, help or hurt a particular party. So they just go on hold from July to November, which I expect they will. But they couldn't raise rates in January or March because it's too close to the last time they said we're not raising rates. So that leaves a window. This is a process of elimination. It leaves a window. The window is April to June. my expectation is one rate cut in that window, just for insurance, just to say, hey, if we're going to go on hold from July to November, and there's some signs that things are slowing down, we better give the economy one last rate cut just to make sure. It's an insurance policy, if you want to use that storied phrase. So I do expect that. The market doesn't, by the way. The market's not looking for that, so there's an opportunity there. But what will that do? Well, it'll give the economy a little boost. It'll help keep us out of recession. It'll give the stock market a boost. And it'll give gold a boost. So my forecast would be Trump wins. Jay Powell helps. I'm not saying that's his mission, but he's boxed in. Jay Powell helps with one more rate cut. That's very positive for stocks and very positive for gold.
Okay, very good. So we are almost out of time. I think we have time to cover maybe one more quick subject. But before we get to that, I had a question I wanted to ask you that's a little off topic. But did you see Nigel Farage's final speech before the EU?
I didn't. I know. Nigel. I've spent some time with him. He's a wonderful guy. He's just very, very cordial and very funny in person. And my meetings with him, we actually don't talk about Brexit much. We talk about the old days of commodities trading in London. He started as a commodities trader, so a good guy and a great orator. And I've seen some of his famous video clips, but I haven't seen his Brexit exit speech, if you want to call it that.
Yeah, no, it's really good, actually. He said some very interesting things that I think you may find interesting. Okay, so for a final topic, what should we talk about? AI or blockchain, fintech stuff? I want to get an update from you on your current view on fintech and blockchain. I know this is your favorite topic. Disrupting traditional financial business models.
Well, let's kind of define disrupting. Here's the thing. We've seen one example after another of technology disrupting existing business models. So, Google and Facebook together put the traditional advertising business out of business, but they kind of bounced back. And obviously, ads are web-based. Nobody watches, television according to the television schedule. We're streaming or recording or watching it online or YouTube or whatever the case may be. And that online advertising has taken over. Electric vehicles are trying to disrupt the internal combustion engine. There are, travel agencies are practically out of business except for high-end exotic tours. We book everything online. So many, many examples. I don't have to list them all. I'm sure the viewers are familiar with them. Why not banking? Why can't blockchain and digital currencies and technology disrupt the banking business model? Well, the answer is they can change it, but they won't disrupt it in the sense of destroying the established players. Why not? Because we're not talking about advertising. We're not talking about travel bookings. We're not talking about online shopping. We're talking about money. We're talking about the banking system. The banking system is always tightly controlled. You just think of any war, World War I, World War II, Napoleonic Wars. Why do you go to war? Well, a lot of reasons, but one reason, you're out to destroy the productive capacity of your enemy and or take it over for yourself and turn it to your own use. Well, what if I could either destroy the productive capacity of my enemy, as in the case of Iran, or take it over and turn it to my own use, as China is attempting to do with Belt and Road Initiative, et cetera. Well, if you can do that with money, then you don't really need an army, or you might. It's good to have one for defensive purposes, but you don't need to go conquer anybody. Just take over the financial system. The best example of this, and I talked about this in my book, The Death of Money, is how Germany has taken over Europe financially. Now they had two strikes. World War I, they invaded and lost. World War II, they invaded and lost. And in the post-World War II environment, they said, why don't we just take over the money system and we don't have to invade anybody? Well, they did that. That's what the euro is, and that's what the European Union is. And so Germany now dominates economic relations in Europe and the European Union and the Eurozone in particular. And I think people understand that the Eurozone, that is the people who use the euro as their currency, is a different group than the European Union. But it's in some ways more important and more powerful. So just look at how Germany bullied Greece, bullied Italy, et cetera. They hold all the purse strings. Nothing happens unless the German Chancellor, now Angela Merkel, maybe that'll change in the not distant future. So after 2 world wars, Germany has achieved its goal, not with armies, but with money. So then the question, just to turn it back to the blockchain people, all these, Silicon Valley 27-year-old developers busy with their blockchain. Do you honestly think that Germany and the European Union and the European Central Bank and the Federal Reserve and the Bank of England are going to let you disrupt their franchise? The answer is no. Now, that doesn't mean we won't see digital currencies. I've said all along that the dollar is the greatest cryptocurrency in the world. Why? Because it's digital. I mean, you may have a couple bucks in your pocket or your purse, but that's not how we spend money. We do it with credit cards, debit cards, PayPal, Apple Pay, direct wire transfers. We get our paychecks through through wire transfers to our bank accounts, et cetera. The last paper Treasury note, I think, was issued maybe around 1981. That system has been completely digital for decades, and all the message traffic is encrypted. So the dollar is a digital cryptocurrency and always has been. So there's less novelty in the whole Bitcoin thing than people realize. Always a Bitcoin is a scam. I know people made a lot of money and other people lost a lot of money. It's a zero-sum game. It's an interesting casino if you're interested, but not much more than that. So we already have digital cryptocurrencies. They're called dollars, euros, and yen. And we already have digital payment systems. It's called FedWire or ACH or SWIFT. And all you have to do is adapt it a little bit so that suddenly you can have, in effect, digital wallets. We call it a bank account, but you can have a digital wallet. So I do expect that the IMF and the central banks, and Mark Carney, Mark Carney should be everyone's favorite central banker because he's been the head of 2 central banks, Canada and the Bank of England, and senior positions in the BIS. So he's sort of one of the masterminds of this whole thing. But central banks are moving quickly to destroy rival cryptocurrencies, develop their own. And so if you ask me whether the financial system will evolve into something that looks more like a digital cryptocurrency blockchain system, my answer is yes. But if you ask me whether that will disrupt the existing banking system, the answer is no, because they have too much power and too much control. To see what the disruptors, the Bitcoin groupies miss is the fact that the central banks actually favor cryptocurrencies. They hate cash. They would love to eliminate cash. Are you kidding me? They've been trying every way they can to get rid of cash. I tell people, well, there's one form of wealth preservation that they can't get rid of, which is gold. If you have physical possession of physical bullion, either through a custodian or a non-bank vault or some other trusted system, then that's a form of wealth that they can't hack, they can't steal, they can't freeze because it's physical bullion. It's non-digital. It's atomic number 79. It's an element. So that's one alternative. But if you're talking about stacks of cash, get ready for the day when there is no cash. It's all digital and the governments control it all. By the way, if this were a trial and I had to put it on an exhibit for the judge and jury, I would just say, look at Facebook Libra. Facebook Libra came out. Oh, Mark Zuckerberg is going to have the greatest cryptocurrency. He's got the biggest user base. He's got, 2 billion, digital subscribers or Facebook users, etc. Yeah, that was about a year ago. And where is it now? It's dead in the water. All the people who signed on pretty quickly quit. Don't be surprised if they got a phone call from their friendly central banker saying, "What are you people thinking? We're going to kill this," and they did.
Yeah, if anything, I think that I watched his testimony before Congress in regards to Libra. I watched the whole thing, 6.5 hours of it. And if anything, it was a gigantic wake-up call. And more than anything, I think it's really on their radar and they're really taking it seriously as far as potential risks, which is only going to motivate them to create their own, I think, as well.
Yeah, and some people say, why was Mark Zuckerberg doing that? Well, think about what Libra is. So I send Mark my money, and he gives me some Libras, which are non-interest bearing. he takes my money, buys treasury bills, and earns interest and gets a spread. So, thank you very much. So you have infinite leverage, positive spread with infinite leverage. That's the kind of business that appeals to Mark Zuckerberg. There's another name for that. It's called banking. And if he thought that he was going to be allowed to be a bank without regulation, he obviously was not well advised.
Sure. Okay, so I think that about wraps it up for as far as time is concerned. Jim, your most recent book is called Aftermath. I personally highly recommend it. I think it's great. I've not read one of your books that I did not like.
Well, thank you. My books have a track record of being a little ahead of their time. You go back and read Currency Wars from 2011, has a long discussion of Ukraine about 8 years before that became the center of the political universe. So I would say Aftermath is the same. A lot of contemporaneous stuff, a lot of things that will have a much bigger impact in the years ahead. So if viewers and listeners want to stay ahead of the curve, and that's all of our jobs, then I do recommend it. Thank you for mentioning it.
You bet. Okay, Jim, it's as usual. It's great to have you back, and look forward to doing this again sometime soon.
Thanks, Alex.
All right, have a great day. Bye.
You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanzik, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.